Show me any financial crisis in history, and I'll show you the exact same pattern. Tulips in 1637, stocks in 1929, housing in 2008. The pattern is always identical. And once you see it, you'll realize it's happening again, right now. I'm Peter, and I study the intersection of engineering and finance, how infrastructure, technology, and money flow together to create and destroy economies. And what I'm about to show you is something most financial advisors either don't know or won't tell you. Every major financial crisis in recorded history follows the exact same 5-stage pattern. No exceptions. By the end of this video, you'll be able to spot the warning signs before the next collapse happens. And more importantly, you'll understand why it keeps happening over and over again. Let's start with something weird. Flowers.
Amsterdam, 1593. A biology professor named Carolus Clusius brings tulip bulbs from Turkey to the Netherlands. Now, this seems innocent enough. It's just a flower, right? But here's what makes this a displacement, the first stage of every financial crisis. A displacement is when something new enters the market that creates legitimate excitement and profit opportunity. For the Dutch, tulips were exotic, beautiful, and, critically, they could be cultivated and sold. Early growers made real money. This wasn't a scam. The profits were genuine. Fast forward to 1720 England. The displacement? The South Sea Company gets exclusive trading rights to Spanish South America. Real opportunity, real profits, real business. 1920s America? The displacement was electrification, automobiles, radio, genuine technological revolution creating real wealth. 2000s? The displacement was the internet, then later financial engineering that supposedly eliminated risk from mortgage lending. Here's the engineering connection nobody talks about. Every displacement involves infrastructure expansion. The Dutch built canal systems for tulip transport. The British built ships for South Sea trade. Americans built electrical grids and highways. The 2000s saw massive construction of suburban housing. The displacement stage is legitimate. Real innovation, real profit, real economic growth. This is why it's so dangerous, because it starts with truth. The pattern always begins with something that actually works, and that's what makes stage 2 inevitable.
Once the displacement proves profitable, stage 2 kicks in, the boom. And the boom has 3 characteristics that appear in every crisis. 1. Easy credit becomes available. In Tulip Mania, traders developed futures contracts. You could buy tulips that didn't exist yet with money you didn't have. Sound familiar? The South Sea Bubble. The company offered loans so people could buy stock on margin. 1920s? Buy now, pay later became mainstream. You could buy stocks with just 10% down. 2008? Subprime mortgages, ninja loans, no income, no job, no assets, and you could buy houses with 0 down payment. The pattern? Credit always expands during the boom phase. 2. Prices rise steadily, not explosively at first, just steadily, consistently, reliably. Tulip prices doubled, then doubled again. South Sea stock climbed month after month. The Dow went up year after year through the 1920s. Housing prices rose for years before 2008. This steady rise is critical because it validates early investors,
attracts new money, creates the illusion of safety, and establishes the trend as normal. 3. The narrative shifts. Early in Stage 2, people invest for profit. By late Stage 2, people invest because everyone is doing it. The Dutch weren't buying tulips for their gardens anymore. They were buying them as investments. Americans in the 1920s weren't buying stocks for dividends. They were buying for price appreciation. In 2008, people weren't buying houses to live in. They were flipping them for profit. Here's the engineering angle. During every boom phase, infrastructure spending goes exponential. The Dutch built elaborate greenhouse systems. The British built massive trading fleets. Americans built suburbs sprawling for miles. Why does this matter? Because infrastructure spending is visible. It creates jobs. It looks like prosperity. It feels real. Politicians love boom phases because unemployment drops, tax revenues rise, and everyone feels wealthy. But here's what's actually happening. The economy is building capacity for a demand level that doesn't actually exist yet. The Dutch built capacity to grow millions of tulips. But who is going to buy millions of tulips? America built millions of suburban houses. But who is going to live in them when the music stopped? This is the trap. The boom creates its own destruction. But nobody sees it because Stage 3 feels too good.
In 1637, Dutch traders genuinely believed tulips would remain valuable forever because they were beautiful and rare. In 1720, British investors believed the South Sea Company would generate infinite wealth from South American trade. In 1929, economists declared we have reached a permanently high plateau in stock prices. In 2007, experts said housing prices never go down nationally. Every single time, the collective delusion is, this time is different. We figured it out. The old rules don't apply. At the peak, your grandmother is giving you stock tips. Shoe shine boys are trading tulips. People are quitting their jobs to day trade. In 1636, Dutch sailors and farmers were trading tulip futures. In 1929, ordinary Americans were borrowing money to buy stocks. In 2006, waitresses owned 5 investment properties. Here's where it gets mathematically absurd. A single tulip bulb sold for 10 times the annual income of a skilled craftsman. Think about that. 1 flower bulb equals 10 years of salary. South Sea Company stock traded at prices that would require 1,000 years of profits to justify. In 1929, stocks traded at 30x earnings when historical average was 15x. In 2006, houses in Phoenix were selling for 10x the annual rent they could generate. During Euphoria, infrastructure projects become absurd. The Dutch were building heated greenhouses for tulips, massive capital investment for flowers. The British were building ships for trade routes that didn't exist yet. Americans in the 1920s were building skyscrapers in small towns that didn't need them. In the 2000s, entire suburban developments were built with no buyers in sight, just speculation. When you see infrastructure being built for imaginary demand, you're at Stage 3. But here's the cruel part. Stage 3 can last years. The tulip euphoria lasted months. The 1920s boom lasted nearly a decade. The housing bubble lasted 5+ years. So people who warned about the bubble look foolish. You've been wrong for years, they say. Until Stage 4 begins, and then everything changes.
Stage 4 is the quietest stage, and that's what makes it so dangerous. In every crisis, insiders start selling before the public realizes anything is wrong.
In the Tulip Mania, professional growers began refusing to honor futures contracts in late 1636, months before the crash. Before the South Sea bubble burst, company directors and British politicians quietly sold their shares while still publicly promoting the stock. In 1929, Joseph Kennedy, JFK's father, famously sold all his stocks when his shoeshine boy started giving him stock tips. He recognized the Euphoria peak. Before 2008, Goldman Sachs was selling mortgage-backed securities to clients while simultaneously betting against those same securities internally. Here's a technical indicator that appears every time. Trading volume spikes, but prices plateau or rise more slowly. This means more people are trying to sell, fewer people are willing to buy at higher prices. The balance is shifting. In Tulip Mania, February 1637 saw massive trading volume, but prices stopped rising. In 1929, September saw record trading volume, but the Dow couldn't break through resistance. In 2007, housing inventory spiked, more sellers than buyers. During Stage 4, the first negative stories appear. Some tulip traders defaulting on contracts, 1637. Questions raised about South Sea Company profits, 1720. Margin calls increasing on Wall Street, 1929. Subprime mortgage defaults rising, 2007. But here's the trap. The mainstream narrative is still positive. CNBC is still bullish. Experts are still saying buy the dip. Politicians are still claiming everything is fine. Stage 4 can last weeks or months. It's the distribution phase, smart money distributing their holdings to dumb money. Infrastructure projects start getting delayed or canceled. Why? Because the smart money knows demand won't materialize. In 1929, major construction projects were quietly shelved in August, September. In 2007, home builders stopped buying land months before the public crash. When you see infrastructure expansion suddenly slow down despite strong economy headlines, you're in Stage 4. But most people miss this entirely because they're still euphoric from Stage 3. And then Stage 5 hits like a freight train. February 3rd, 1637. A routine tulip auction in Harlem fails. No buyers show up. Within days, the entire market collapses. September 1720. The South Sea Company admits it can't pay promised dividends. Stock drops 80% in weeks. October 24th, 1929. Black Thursday. 12.9 million shares traded. Record volume. October 29th. Black Tuesday. 16 million shares. Market down 25% in 2 days. September 15th, 2008. Lehman Brothers files for bankruptcy. Credit markets freeze globally within 48 hours. The trigger is never the cause. The cause was stages 1 through 4. The trigger just reveals what was already true. Tulip traders who bought on credit are forced to sell at any price. 1929 investors who bought on 10% margin are wiped out. 2008 homeowners with adjustable rate mortgages can't refinance. Credit disappears. The easy credit from Stage 2? Gone instantly. Banks stop lending. Liquidity evaporates. Cash becomes king. Price collapse accelerates. Tulips that sold for 10 years' salary now can't find buyers at any price. South Sea stock loses 90% of value. Dow drops 89% from peak to trough. Housing prices drop 30 to 50% in many markets. The psychology reverses.
And this is where my engineering background reveals something crucial. All that infrastructure built in stages 2 and 3, it becomes stranded assets. Dutch greenhouses sit empty. British ships rot in harbors. American skyscrapers stand vacant. Suburban developments become ghost towns. The physical evidence of the bubble remains for decades. Drive through parts of Phoenix or Las Vegas today. You'll still see empty developments from 2008. After Tulip Mania, Dutch traders faced bankruptcy and social shame for years. After 1929, unemployment hit 25%. Families lost homes. Suicides spiked. After 2008, 10 million Americans lost their homes. Retirement accounts were decimated. The pattern doesn't just repeat in markets. It repeats in human suffering. And here's the terrifying part. We're watching the pattern unfold again, right now.
So where are we in the pattern today? Let me show you the warning signs. We've had multiple displacements in the last decade. Cryptocurrency and blockchain, legitimate technology. AI and machine learning, real innovation. Zero interest rate policy enabling massive debt, financial engineering. Meme stocks and retail trading apps, democratized access. Each of these started as legitimate opportunities, real profits, real innovation. Stage 2 indicators present. Easy credit, you can borrow money at historically low rates. Steady price rises. Stock market hit all-time highs repeatedly. Narrative shift. People investing in things they don't understand. NFTs, SPACs, meme stocks. Stage 3 red flags. This time is different. Stocks only go up. The Fed has our back. Inflation is transitory. Everyone wants in. Your relatives asking about crypto, GameStop, AMC. Prices detached from fundamentals. Companies with no profits trading at billion-dollar valuations. Infrastructure absurdity. Massive data centers built for crypto mining. Office buildings nobody needs. Stage 4 signals. This is where it gets interesting. We're seeing insider selling at record levels. Volume patterns changing. Narratives starting to crack. Infrastructure projects being reconsidered. I'm not saying collapse is imminent. Stage 4 can last months or years, but the pattern is visible. The difference this time. Here's what's genuinely different in 2024-2025. Central banks are aware of the pattern. They're trying to engineer a soft landing. Information spreads faster. Social media means panics can happen in hours, not weeks. Global interconnection. A crisis anywhere can cascade everywhere instantly. Retail participation. More ordinary people are in markets than ever before. Does this mean this time is different? Maybe, but that's what they said in 1929, 2000, and 2007. What should you watch? Credit conditions. When does borrowing get harder? Volume versus price. Are prices rising on decreasing volume? Infrastructure spending. Are major projects being delayed? Insider behavior. Are executives selling stock? Narrative shift. When do mainstream outlets turn bearish? The pattern suggests we're somewhere between stage 3 and 4. But timing is impossible to predict. So, what do you do?
Understanding the pattern doesn't mean you can time the market perfectly, but it does mean you can protect yourself. Strategy 1. Recognize your position in the cycle. Ask yourself honestly, am I buying because of fundamentals or because everyone else is? Would I buy this asset if prices were 50% lower? Do I understand what I'm investing in? Am I using debt to invest? If you're buying because of FOMO, fear of missing out, you're in stage 3 thinking. Strategy 2, maintain liquidity. In every crisis, cash becomes king. Those who had liquidity during 1637 could buy tulip bulbs for pennies. 1929 could buy stocks at 10% of peak prices. 2008 could buy houses at massive discounts. The pattern teaches don't be 100% invested at the peak. Keep dry powder. Strategy 3, diversification across time. Don't try to time the market. Instead, dollar cost average into positions. Take profits gradually as prices rise. Rebalance regularly. Don't go all in or all out. Strategy 4, understand leverage. Every crisis is amplified by debt. The tulip traders, 1929 investors, and 2008 homeowners who used maximum leverage were completely wiped out. Those who invested only what they could afford to lose survived and thrived. The pattern teaches don't be 100% invested at the peak. Keep dry powder. Strategy 5, study the pattern. The more you understand financial history, the less likely you are to repeat it. This is why this channel exists. When you see stage 3 euphoria, you'll recognize it. When you see stage 4 distribution, you'll be prepared. What not to do? Don't try to short the market at the peak. Timing is impossible. Don't panic sell during stage 5. That's when smart money buys. Don't assume you're smarter than the market. Don't invest money you need in the next 5 years. The engineering mindset. As an engineer, I think about systems and failure modes. Financial markets are systems. They have predictable failure modes. You wouldn't design a bridge without understanding how bridges fail. Why invest without understanding how markets fail? The pattern repeats because human psychology repeats. Greed, fear, euphoria, panic. These are constants. But knowledge is power. Now you know the pattern. You can't unsee it. And that gives you an edge that 99% of investors don't have.
So let me bring this full circle. Tulips in 1637, stocks in 1720, the crash of 1929, the housing crisis of 2008. 5 stages, same pattern, every single time. Displacement, something new and legitimate. Boom, easy credit and steady gains. Euphoria, this time is different. Profit-taking, smart money exits quietly. Panic, the cascade collapse. The pattern has repeated for 400 years. It will repeat again. But now you can see it. You understand the stages. You recognize the warning signs. And that's the weird part, isn't it? The pattern is completely predictable, yet people fall for it every single time. Why? Because each generation thinks they're different. Each era thinks they've figured it out. Each bubble feels unique while it's happening. But the pattern doesn't care about your feelings. It doesn't care about innovation or technology or new paradigms. The pattern is driven by human psychology, and human psychology hasn't changed in 400 years. This is the first video in a series where I'll break down the engineering and financial patterns that shape our world. We'll explore how infrastructure spending predicts economic crashes, the railroad bubble that bankrupted America in 1873, how a single banking family accidentally built the British Empire, and many more.